Um, Good evening. Happy Thursday, everyone. I will kick this off. My name is San Ing, and I'm super excited and happy to be here with our partners here to discuss a very fun and exciting project called Elysium Apartments in downtown St. Pete in Tampa, Florida. I will see if I can share my screen. Let me know if you guys see the screen, Irene. Is the screen showing?
Yes.
Okay. So, wait till it pops up. Oops. There we go. Right. Okay. Again, welcome. This is the webinar for Elysium Apartments. I'm one of the co-hosts here. I'm Sand. We'll go ahead and introduce everybody in a couple of minutes. But I'm personally very excited for three reasons to be here. A couple of firsts for us. One is the asset that we're hoping to share with you tonight that we're investing in ourselves is truly a unique, attractive asset. This is the seventh multifamily asset that we're closing in the last 18 months in Tampa. And although this is the smallest one, it's also to us the most exciting and in many ways the most attractive. The second reason is this is the second project that we're doing what we're calling this BFL, branded furnished leasing model, which unlocks a lot of value for the partners and investors. But the most exciting reason is I'm co-hosting and co-leading this project with not only Cindy, who's working with us on an earlier project, but also Sophia, but most importantly, my daughter Ia, who is her first multifamily project after spending quite a number of years learning and attacking deals and underwriting. So I think most importantly, we want to start with introducing the team. Now, I want to know, are we seeing the slide and the videos as well, or just the slide right now?
Yeah, we can see the video.
Only the video?
No, we can see the slide and the video. Do you want me to share?
Okay, great.
Because
yeah, do you want to do it? You're probably better.
Yeah, I'll just share my
please.
screen.
Thank you. Yeah. Sorry, folks. I've been to too many Zooms, but not necessarily as a webinar host.
Okay, you can continue.
Okay, great. Thanks, dear. So yeah, so we'll just go introduce first. So myself, I'm San again. I want to give a bit of background. This is a very special project. Again, it's relatively a small project, a $2.2 million project. But it's special for a lot of reasons, as I mentioned. It's actually many years in the making. One of my life missions that I've stated very publicly is to help my three daughters. Ia is 19, she's pictured here, as well as the two youngest sisters, try to achieve financial freedom through investing and through other means. Yeah, you might want to stop moving the cursor. It's a little distracting. Thank you. So one of my life missions is really to try to figure out a way to help the kids to learn to invest and find a way to financial freedom. And so we see this project as a major stepping stone with Ia to get to that goal. A couple of years ago, we also published a book together, and she'll tell you more about that helped her lead to this journey. But I'll stop there and I'll let Ia sort of explain sort of her reasons and what she's doing here.
Hi, I'm Ia. I'm 19 and I'm San's daughter, as you mentioned. And I've always really liked investing. When I was really young, my dad actually force-fed me and my sisters Rich Dad, Poor Dad. And so since then, I've always taken an active interest in trying to make money. So I've sold stickers online, I've tutored, I've waitressed. And from those ventures, I kind of learned that what I value most is my time. And so from a young age, I've always wanted to work my way to financial freedom so that I would have my time and my resources free to do the things I love and spend time with the people I love. And so my dad mentioned a book that we co-wrote over quarantine. This book was called The 10 Commandments of Investing. And essentially it was a guidebook to what we believe are the 10 commandments to investing across multiple asset classes and strategies and geographies. And the proceeds of the book are being donated to charities supporting financial freedom. But through the course of researching for this book, I looked at a lot of different asset classes, and kind of similarly to my dad, I thought that multifamily real estate was a really wonderful asset class, a really stable asset class, and one that is not easy to learn, but I think it has a good entryway for people that, for example, I haven't gone to college yet, I'm on a gap year. You can step foot into that world and learn about it and make money from it. And so I've spent the past 3 years studying multiple different real estate strategies, including BRRRR and also syndication. And most recently, this is my first deal. And so it's important to me, not just because it's my first, but also because I hope that it'll be the first of many on my path to financial independence. Oh yeah.
So yeah, I just want to add, it hasn't been easy in the past year during the her gap year. I think we drove Toronto, New York to Tampa, Texas, from Tampa, and then back to East Coast, really looking at different markets. And then we spent the month of May looking at hundreds of deals, underwriting quite a few dozen. And perhaps as irony, we ended up liking the same deal, which is this one. So anyways, why don't we go to the next slide and invite Sophia and Cindy to introduce themselves.
Hi, I'm Sophia, Yia's mom. My background is investment banking and startups, specifically raising money for corporations and young companies, and also managing their finances. My role in Elysium will be to support all financial matters, as I'm currently doing with Skytian, of Skytian's investments. I have bachelor's in finance and real estate from Wharton, and currently based in Toronto. I started in real estate investing by investing in condos and single family, but decided that multifamily can create a lot more opportunities for my girls without having to go through the traditional route like me, and I hope to inspire them. Well, Ia's already very inspired, but her young sisters to pursue that area so that they can pursue their, I don't know, dream career instead of, being instead of having to go to the traditional corporate route. And one of my biggest regret is working in New York in my 20s, making money in banking, but spending time and money shopping on Fifth Avenue instead of buying. Okay, and I'd like to introduce our other amazing partner, Cindy.
Hi, everyone. My name is Cindy. I am so honored and happy to be here, spending this hour with everyone here. So as Sam mentioned, Elysium is a $2.2 million deal. And in multifamily space, this is probably one of the smallest deal for many of you here. However, the story behind the Elysium is nothing small, right? So it is about San, the father, mentoring Ia, the 19-year-old, on this journey to be financially free by age of 21. And for Ia, of course, at age of 19, to have this goal to become financially free by age of 21, it's nothing small, right? So I am truly inspired by this. And to me, being financially free is to be achieved at any age, not just at age 21. I asked myself what I was doing at age 21, right? And for me, so a little bit about me is that I started my career as an auditor with Ernst & Young a while ago. And then with my late husband, we decided to become restaurateur about 12 years ago. So in the last 12 years, we have extensive experience in that industry with management and also with service in the hospitality sector. So I really think that with that experience can translate over to multifamily, especially in the model with Elysium. So I was really fortunate to have the opportunity to work with Sun on the 41 unit Satoshi project this year. And that's our first project converting long-term rental to the flexible leasing model. So Elysium will be our second project. And again, I am very, very excited to be a part of this project.
Great. Okay, and last but not least, we also have Irene, who's in our team, supporting us in many ways. Irene, thanks for setting this up. Yeah, we hope you don't mind. We wanted to spend a bit more time on the folks behind this project, the lovely ladies here, just because you know, no matter how good the asset is, it all depends on the folks that are behind it. And so hopefully this gives some color to sort of the motivations and the folks that will be working with you if you choose to partner with us. So Ia, would you mind going to the next slide? So just a bit of homework, I suppose, by the lawyer. We are not financial advisors, attorneys, or accountants. And this is a 506c offering, which means is legally only given to accredited investors. We encourage you to definitely check with your advisors. This is an information session. So thank you for that. Okay, so this is really the punchline summary slide and also serves as the agenda, okay? As we mentioned a few times, this is less about a fundraising than it is really to for this particular project to perhaps introduce the team here and our ambition to do many more deals like this and potentially partner with many of you in different ways. But the headline says this is really truly a rare legacy asset, and we'll explain what that means, in downtown St. Pete in Tampa. And of at least the 6 prior deals to this one, which are doing pretty well, this one, in our view, is the one that is the most attractive with tremendous upside. So we'll, in this, the next 20, 30 minutes, we'll talk about 8 topics. We just introduced a team. The team collectively, this is our 7th deal in Tampa alone since last February. We currently manage 63 million of assets of multifamily in Tampa, about 258 doors. We've been very fortunate with great partners finding good assets. Our first project that we purchased in February last year, a 76 unit, knock on wood, should close officially 6 days from now, July 20th, with a 75% IRR to our passive investors. The second project we invested, called Coconut Villas, and I see some of the partners, investors here as well, is partially exited and is slated to be fully exited by year end, also trending towards a 70+ IRR. We've been very lucky to have, again, found great assets, to have worked with great partners, and to have timed it pretty well. And so since we've done well, we have also very much like to keep focusing and growing our scale and expertise in Tampa. In particular, my favorite submarket is downtown St. Pete, which is where Elysium is as well. It's being called multiple times as sort of the Austin of the East, although I frankly think this has a lot more, has other features that might make this even more attractive than Austin. I will spend a bit of time talking about the business model. I see from the list here, there's some the majority of you are very experienced multifamily real estate investors, and some are a bit younger in that space. Regardless, the model that we are deploying for Elysium, it's a unique model that we believe will unlock tremendous value versus, let's say, traditional multifamily model. And then Ian will introduce the asset itself, which is a small, we're under contract to purchase this 12 units for 2.2 million. But it's really the asset value as well as the land value. We have 3 lots. It's a very big lot in what's called a downtown core, DC2 core zone. Just for comparison, the lot next doors, we're 805 4th Avenue, the lot at 707 4th Avenue, also DC2, vacant lot. We tried to purchase it just to connect it to you, but it went under contract for 3.5 million without any buildings. So we'll explain a bit more about that dynamic later, as Azir will do that. Here we'll also explain the conservative base case, income, operating expense, capital expenditure, debt assumptions, the key drivers that lead to the 5-year projections, and of course, the returns scenarios. Our model and base case actually does not model in a number of attractive upside cases. For example, we intend to add additional units by ADUs. These are sort of like pre-made modern homes. Longer term, DC2 is grandfathered in for us to develop up to 20 stories in that lot. And the base case though will show, again, without the upside, that we can comfortably cash out refi all the investments within 1 to 2 years, while we keep the same equity percentage in that asset for a long-term forever legacy hold. Again, we'll explain that. This is the part that this is the type of project that Skytian and I personally love to do, is find projects to add value, and then in 1, 2, 3 years time, have the ability to cash out, refi the principal, and essentially then own the asset for free. I learned this early on from my brother Michael, who I've done a few deals with, and just fell in love with this business model. So specifically, point A, what is the opportunity that we're offering? The total investment we need net of debt is 1 million. The sponsors here, the 4 of us here, are putting 40% of that in common equity. We're offering to partners here, mostly friends here, up to maximum 600,000, of which the minimum investment is 25,000, and the maximum, I believe, is 150. I think that's what we decided. And the investment will be split between what's called Prefer A1 and Prefer A2. Very simply, Prefer A2 just means this is a flat 12% prefer return. Cash flows from operations after the loan will first go to Prefer A2. There will be no equity participation and no depreciation allocation. And then Prefer A1 collects a 7% prefer return after the A2 collects a 12%. They do enjoy pro rata equity ownership and pro rata depreciation. And the projected base case return on that is 10% cash on cash and an overall 5-year 2.7 times multiple. Again, the sponsors will be investing only in common equity, which means that should the asset not perform, should we not perform, we will be last in line to collect any cash flows, hence hopefully showing our confidence in the project. So that is the punchline. Hopefully that's exciting, and we can keep going down. Again, I'll introduce the market and business model, and the EA will take over from there. All right, we love Florida. I love Florida. In my since COVID, I think about 2 years, 18 months, I have literally driven 49,000 miles in my Tesla Y all over the country, from East Coast, Toronto, all the way to Texas and back multiple times, and many trips to Florida, looking at different markets. And I think the folks here know that, most of the folks here that do real estate know that Florida and Texas are the 2 states that are the most attractive, largely because there are net migration of population due to job growth. I personally invest in Texas as well, in other markets as a passive investor. but from a deal hunting and concentration of time and priority, it's Florida for me for all the reasons that we see on the right side. This is a fairly detailed deck, so we're not going to go to every single point, but this video as well as this presentation will be made available tomorrow in the Dropbox for you. So next slide, please, here. So Florida, in our view, is #1 in North America, and Tampa, we believe, is the #1 market in Florida, and which is why we're doing quite a few deals here. This is a co-star. Miami actually is the #1 rent growth market. I think it went up 58% last year on year. Tampa is a bit more modest, at only 24-25%, but we believe the Tampa growth is a bit more sustainable for a number of reasons that I think most of us have followed will know. It's healthier, it's a very diversified market in terms of jobs growth, and again, it's starting from a much more affordable base. So, Florida is #1 in North America, Tampa is #1 in Florida, and then specifically after having invested in so many sub-markets in Tampa, we have fallen in love and in fact have opened a temporary office in downtown St. Pete for Skytian. So St. Pete is also where I'm hunting for a place to live. It's just a very great downtown. Again, for all the reasons we talked about, very diversified growth, jobs, a lot of development, the Tropicana feel, walking distance from Elysium and Satoshi is a $3 billion project. ArcInvest, which is the big ETF fund, moved their headquarters from New York earlier this year to St. Pete and building a large innovation center employing 4-figure jobs. Just a lot of announcements, daily announcements in downtown St. Pete. We'll talk about ADUs later that allows for density improvements and including our lot. But those are business. The reason that I love St. Pete is it's a very creative hub. I believe it's probably one of the largest creative communities in the nation. There's a lot of young tech nomads, work from home folks that are hanging out in downtown, very buzzy, very much Austin-like, very much like Shanghai in the days that we were living in Shanghai. Of course, for sports fans, nothing beats Tampa. Tourism itself, we're minutes from the beach all around. And surprisingly, by meeting more folks like Cindy that live in Tampa and other Chinese and Asian friends, one of my pet peeves, we now have actually discovered quite a few good Asian food restaurants, making it much more livable. So anyways, so that's the market. We love the market. I wanted to spend a couple minutes on the business model. I started in multifamily. We acquire multifamily. We look for ways to look value. We rehab it, and then we rent it out long term, and that's fantastic. We'll keep doing that. But what we're finding is the mega trends of really in core downtown areas like Elysium, there aren't any large multifamilies. There's 10 units, there's 30, 40 units. And if we do the traditional model, it's tough to scale up. However, if we take a smaller asset like Elysium and like Satoshi, maybe you can click on one of the links. We are able to unlock a lot of value to justify not necessarily scale, but in terms of value creation for us and our investors. So what we do is we brand it, we turn it unfurnished long-term rental units into branded, furnished, flexible leasing units. And so in the case of the Satoshi project that Cindy and I partner on, we closed this in April, right, Cindy? That we're now transforming, branded. There's a story. This one is called Satoshi Hideout. And we actually created a brand around this thing with local designers to make this very boutique. It's in the process of being transformed. And this is obviously to attract the young and digital and the hip that are really flocking to St. Pete. And what this does is with the brand and a bit of scale, when we offer it as a flexible leasing, when we offer it as a month to month, we attract a lot more guests at obviously higher values because we offer a very cool place to live. So if we go back to next, and so that's the branding part. In terms of economics, how BFL business model looks is typically if you turn an unfurnished long-term unit into a furnish month to month, for example, you rent it to one of the nurses that might work in the local hospital near us, you can typically double the rent. Okay, depending on how it's furnished, whether it's cool amenities, you might 2.5x it. And if you take the same long-term unit unfurnished and you furnish it, and then you offer it as an Airbnb as a short-term rental, the ADRs, the average daily rates times, let's say 70% occupancy, you can normally triple the income. Now, of course, the operating expenses go up. For example, in traditional multifamily, we do maybe 3% management fees. In the case of Satoshi, we actually have a 10% up to 20% management fee for the property management company tied to performance of the asset. Okay, so that's the model, but the OpEx does not rise as fast as the income. Thereby, we materially increase the cash flows and the incomes. Okay, and because we're doing this in scale, 12 units, maybe expanding to 20, 30 units, in Satoshi case is 40 units, and our assets have often amenities, and it's branded and it's managed professionally, we believe we should also outperform a standard month-to-month or a mom-and-pop Airbnb shop. Okay. Now, I want to highlight probably the most important point here. The BFL model, you might ask, well, isn't that just a hotel? No, we're not a hotel. Isn't that just like a Somerset service apartment or Citadines? I was just in Paris earlier this week. We stayed in the Citadines. The answer is also no. Hotels and motels and service apartments have staff. They have front desk. They have staff. Our model is run and owned like a traditional multifamily, and we do not have staff. Now, the partners here are not in salary. We are investors like you. We do asset manage, and we control and manage for example, the renovations, but we certainly manage the property management company. But the day-to-day is really run by the PM, just like a traditional multifamily. And this is important because it signals to investors and it signals to lenders that we are more multifamily than hotel. And so when we do a refinancing or when we sell the asset, we can argue, as we have successfully done so with Satoshi, to be valued at a multifamily cap rate, for example, 5%, as opposed to a hotel, which is 8%. And again, the folks that are here that have done multifamily investments will know a 5% cap rate versus an 8% cap rate. It's a massive difference in value creation. Okay, so I know this is a lot of information. We're happy to answer more questions later, but essentially, we're very excited. Elysium would follow the model of Satoshi. We will use the same property management company that we're using with Satoshi, who's doing really good for us, as well as the same general contractor. They're within walking distance. So the risk of executing Elysium is going to be a lot lower because we've done this before and we're doing this already. Okay, so that might be a little more than we should, but yeah, can you please run us through this fantastic asset that we're acquiring?
Yeah, thank you. So I want to start talking about actually the land with this asset. You can see from this map that Elysium is in a really good location. It's near a lot of the major hospitals, St. Anthony's, Johns Hopkins. It's pretty close to the water, and it's also around a lot of big developments such as the Tropicana field where the Tampa Bay Rays play. So that's a little bit of an overview of where it's located in St. Pete. And this picture on the right, you can kind of see we're on a pretty big lot, which I'll talk about in this next slide. So Elysium, we purchased Elysium for $2.2 million for 12 units. And so looking at the price per door, it's pretty on par with other apartment sale comps nearby. And we mostly looked at other DC2 apartment sales. And so as my dad mentioned, DC2 stands for Downtown Core 2 Zone. And all that means is that it's zoned so that you can build the land up in the future up to 20 stories mixed use. So per door, we paid around $183. And what's more attractive, I think, is the lot price per square foot. Because we have such a large lot at over 15,000 square foot, you can see that we're paying around $141 per square foot compared to much higher numbers of 160 all the way up to 400. And a little bit more about the land. As I mentioned, we're paying 141 per square foot. And my dad also mentioned the adjacent lot that's land only, that's actually smaller at 14,000 square foot. That's under contract for 249. So that's 76% higher than what we're paying for our Elysium, which includes a lot and the building. And in December of last year, there was actually also an appraisal done for the land in Elysium Apartments. This was done by BBG, which is a pretty well-known, reputable appraiser. And they actually appraised just the land at 2.56 million. And so you'll remember that we paid lower than that, 2.2 million for the entire asset. So we believe that this is a really good value. As for the actual building, Elysium is 8 studios at around 325 square feet and 4 one-bedrooms at around 500 square feet. This is a 1925 vintage. However, the roof is from 2020 and the porch was replaced only 3 years ago. So it's in pretty good shape. Also, the current owner recently lightly renovated 3 out of the 4 one-bedrooms. And he's been taking really good care of the property. He updated the electric as well as separately metered all the properties, and also installed central air in 2 of the units. And these pictures are pictures of the interiors pre-rehab. Also, all of the tenants in the property are month to month. So our immediate plan is to turn Elysium into a convert Elysium into branded furnished flex leasing. And our initial CapEx plan, including interiors, exteriors, furnitures for all the units, and as well as appliances, is at around $43,000 per door. And as my dad mentioned, we've worked with a general contractor that we plan to use for this project, and he's confirmed that we will be able to rehab and furnish Elysium in 2 to 4 months. So that's the immediate plan. And in the midterm, we want to add ADUs. So as mentioned, ADU stands for accessory dwelling units, and they're essentially just independent little units that can sit on the same lot as a main residence or a main property. And St. Pete has recently been drafting laws that are very pro ADU. You can see in the highlighted line that they're going to start allowing ADUs for single family houses in multifamily districts. And this screenshot is actually from a St. Pete 2050 larger plan that was shared with us about how they're going to change the city codes. And so in addition to allowing ADUs on multifamily properties, they're also just waiving a lot of like the parking requirements. They're making the unit sizes more lax, and just making it a lot easier to approve ADUs on properties, including ours. And so this slide has a few pictures of a few ADU options. There are all kinds of different ones, but they're usually all able to be installed and built and bought for $70,000 to $100,000 per unit. And a lot of them can actually be installed very quickly, some as quick as 1 day. So this is a really good alternative because it's a lot cheaper to build at $100K per unit than a traditional unit. And another cool thing about these is that, as you can see, hopefully they look a lot cooler. They have more appeal. And also a lot of them are set up to be operating off-grid using solar power. So there's also the aspect of sustainability. So that's our short and midterm plan. And in the long term, because we're zoned downtown core 2, we're able to construct up to 20 stories of mixed use. And so this picture in the slide that you see is a screenshot from a nearby property, 747 4th Avenue or 805. And this is only 300 feet away from us. And this was recently sold or under contract for almost $3.5 million. And to clarify, this is just an empty piece of land. And the picture of these condos is just a mock-up. So the people that bought this land are planning to build 60 luxury condo units on their piece of land. And so since our piece of land is also zoned the same, this is another option for us in the future to either build or to sell it for that development potential. So that's a little bit about the asset. I'll move on to our key assumptions and our financial model. So in our conservative base case, we are assuming 50% month-to-month and 50% short-term rentals. And the short-term rentals, we always model at 75% occupancy, just to be a little bit more conservative. So you can see that at market, our studios and one beds are at around 1,300 and 1,400, but with the 50% month-to-month and 50% short-term rental, we around like 2x the rental income. So that's our assumption for the rent. And just to give a little bit of context with comping, this chart below has some short-term rental comps. We did a lot of research on the daily rates used on sites such as Airbnb, and looked at, what their rehab looked like, what their interior looked like, and what their location was like. And so that's how we came up with our 125 and 140 daily rate. We also did some month-to-month comps for the other half of our assumption. The one that I would like to highlight is in this first row, 809 4th Avenue. This is actually right next door to us, and they have studios of the exact same size and really similar layouts as us. And they're actually already operating as an Airbnb. They're also a 1925 vintage, and they're actually usually pretty fully booked. And they're going for around 2,400 a month. However, they look pretty homey. For example, they have white appliances and they have not been recently renovated. So post rehab, we hope that we'll definitely be able to surpass the 2,400. And there are also some other comps, but I will move on. Okay, so for operating expenses, even though we are assuming 50% month-to-month, which usually has lower expenses, and 50% short-term rental, which usually has higher expenses, we are aligning our operating expenses to be higher and more conservative with short-term rental assumptions. So we also included a 10 to 12% property management fee in the P&L. But other than that, we have, for our T12 versus our pro forma expenses, we are almost doubling that to be a little bit conservative. As for our financing assumption, we've already signed a term sheet for a 75% loan to cost and rehab. And this would be a fixed 5-year loan at 5.35 to 5.5%. And we also have a few other loan backup options. And this is our cash flow forecast. So this is going to be a pretty highly cash flowing asset after we rehab. And this 5-year cash flow actually does not model the refinance, which we'll talk a little bit more about later. A few things I'd like to draw your attention to is on the top line over here, we modeled for year 1 a 40% economic vacancy, and that's on top of the 75% occupancy that I mentioned earlier. And also in year 1, this 9,000, the only other income that we're assuming is parking. So that's around 15 parking spaces. And there's minimal work to be done before we need to rent out parking. So that's an easy way to add income before our midterm plan of adding more units. Yeah, so year 1, you can see that we're not cash flowing too much at 1%, but once we stabilize doing all the rehab in year 1, year 2 and 3 and 4, you can see the cash flow gets a lot higher at 16, 19, and 21%. And we also stabilize our economic vacancy from 40% to 8% after year 1. And the PM fee, as I mentioned, is also included in this forecast. So I'll hand it over to you, Dad, to talk about the refinance a little.
Yeah, you're doing a much better job. Why don't you continue? You don't want to? Okay. Okay, well, the cash flows are small, but again, we'll make copies available to you. What this basically says on the left side is that we, in this base case, we will be putting just a bit south of 3 million, which is about 2 million in primary debt. And then the preferred A1, A2 would be 600,000, and on top of that, 400,000 from the sponsors here for about a 3 million initial capital investment to close this project. And based on the assumptions and the cash flows that Year just walked us through, it says year 2 and year 2, that the last column on the right should be year 3. Year 2, we should be generating about 262,000 in NOI, and using a conservative 6.5% cap rate, which again, if we're valued as a hotel, lenders might use an 8% cap rate. If we're using multifamilies, anywhere between 3% to 5%, 5.5%, depending on the asset class and the size. Here we use 6.5, which we feel is extremely conservative. We would then be valued at about 4 million. If we use 6% cap rate, we would be closer to a 4.8 million value in year 2. Year 3, obviously, we would be generating higher NOI and would be valued higher. So assuming we take the year 2, 4 million, 6.5% cap rate valuation, and then we do refinancing at 75%, that means 75% times 4 million, we would then be able to take out 3 million in a new loan. And that 3 million on the right base case is obviously greater than the 2.9 million that we put in year 0. And so what that means is basically at this refi, when it happens, is we would be able to return not only the primary debt with this higher debt amount, we would also be able to return all the A1 investments, the A2 investments, and as well as hopefully anything left over would be the investments from the common equity, and importantly, maintaining our equity ownership in this asset for a long-term legacy hold. Okay. I'm kind of run through that quickly, but hopefully, and yeah, if you go back to that one, and for folks that have not done a lot of multifamily or the cash out refi strategy, I just like you to know that we've actually done this a number of times already. In the past 2 years, for 2 small assets in New Jersey, one we did 100% cash out refi in about 18 months. And then we recently, with another asset, did an 85% cash out refi in about 18 months. The Clearwater project that we invested in February, the 76 units, my partners decided to sell it. We bought it for $6.8 million last February. Next week, it's going to close at 12.1 million, generating a very, very high return for our investors. But we could have chosen to refinance that asset and taken 100% of the equity while keeping that asset. Okay, so it's really the same play. For this Elysium project, our intention is to cash out refi and hold on to it forever, potentially adding more units or potentially developing the 20 stories as Ye mentioned. Okay, Ye, back to you.
All right, so the base case numbers that we just ran through was our conservative base case at 50% month-to-month in short term. And we also modeled a worst case and an achievable upside case. So starting with the worst case, we actually modeled 0 short term, and it would be 100% month-to-month. And you'll recall that our loan terms were 5.35 to 5.5%, but we modeled a 7% interest rate with no other income and a pretty high reversion cap of 8%. And that scenario yields us a 7% cash on cash and 1.6x multiple. And then for our achievable upside case, we are assuming a 20% month-to-month and 80% short-term with the interest rate of 5.3%. And instead of parking for our other income, in this scenario, we are adding 8 of the accessory dwelling units. And we assume that they cash flow at a conservative $2,000 a month at 75% occupancy with a reversion cap of 6%. And we also modeled in the CapEx of $100K per ADU unit to install and build. And that yields us a cash on cash of almost 15% and a 3.8x multiple. And there's still actually more further upside because we can add even more ADU units. We have the option of subdividing the 3 lots and selling them, or even just developing up to 20 stories mixed use as mentioned. Okay. And so this is our investment summary. I'll hand it off to my dad, and then that will be the end of the presentation.
Yeah, we're pretty much done. So as we mentioned, this is a $1 million raise, 40% committed by the team here. And we're offering, again, this is less about the raise than really, there's a few folks here that are from family offices. One of my mentors is here. We have a bunch of Sunrock folks here. It is to really communicate this strategy that we were doing for version 2 of this BFL strategy, and hopefully get feedback, get partners that are interested, and to scale this up. Again, less for fundraising than really to find longer term partners that we could work with to do multifamily, as well as to do this BFL business model, which we do hope to scale up. But the deal terms, as we discussed, are minimum 25,000 accredited only, and the 25,000 must be split between half of A1 and A2. I think we talked about that already, so I'm not going to repeat that. We did get a preliminary cost seg study from an expert firm, and the equity owners would be able to expect to get about 70–80% losses to mitigate taxes on this project. We're charging a standard 2.5% asset management fee for a smaller asset. Sometimes it's 2%. This is a small asset, and then the profit share for the sponsors is 20% after all the A1, A2 returns after the debt. And then once we achieve and exceed a 15% IRR to the LPs, we would then charge a 30% profit share. So next couple of days, we will have the information in this company called Cash Flow Portal, which is also an investment by Skytian as well. We're small investors in to generate the paperwork. And then the last slide, and we'll turn to questions, is just a time frame. Today is the 14th right here. So tomorrow we'll have a war room set up in Dropbox with this deck, this video, as well as other useful information. Give the folks here some time to digest, ask questions. And the idea is to then decide and allocate the investors around the 20th, have you folks fill out the paperwork, and then target funding end of July with an expected close sometime in September. Okay. Maybe Cindy or Sophia, do you ladies have anything to add that we might have missed? You're muted. Okay, yeah, maybe you could unshare the screen, and we can, I think we see some questions. One question is about the team's history, I suppose, with flex leasing and Airbnb and whatnot. Cindy, this is over to you. You've got the most experience there.
Oh, I just unmuted myself. So about our business model, as we have mentioned, currently San and I, we are working on the 41 unit Satoshi project. We are halfway done rehabbing. It's a 2 building, so we rehab 1. We started with the 2nd building right now. And Sang also mentioned that we work with a local property management company who is very experienced in the short-term rental space. And his company, part of their operation also includes cleaning service. So everything is so we only had to deal with 1 vendor versus a separate cleaning company, and then the PM, it's all done through the PM. So pre-rehab of Satoshi, we are seeing great ADR. with good occupancy rate. So we really believe and very confident that post-rehab of Satoshi, we are able to achieve the pro forma numbers. If not, I mean, we probably will overachieve, but at least we can meet the pro forma. So with Elysium being the second project, we are even more experienced and more confident in this deal.
Yeah, Cindy, thank you. Just want to add, the property management company is, we have a cross shareholding. One of the investors in Satoshi is also an investor in that property management company. And in the case of Elysium, the boss of this PM company, it's going to show skin in the game two ways. One is the structure we have is a very low base percentage, and they get a bonus tied to the increases in the NOI. So in the case of Satoshi, for example, we're starting with a 10% base, which is unusually low, as Cindy knows, for short-term rentals, but they have a chance to get up to as high as 20% if they reach very big numbers that will help us refi, with the eyes closed. And so we would have a similar structure, performance-based structure for this same PM for Elysium. And on top of that, the CEO of this company has also asked to co-invest in this project as well. And in terms of time frame, Satoshi, we acquired in April. The business model, I think we also have a couple of Satoshi investors, partners here too, was to really, in the performers, to finish the rehab, probably most aggressively end of the year, right, Cindy? We currently are aggressively trying to finish the rehab stage 1 at least, so we can brand it Satoshi by the end of August, way ahead of schedule.
Mm-hmm.
So, okay, there's so I hope that answers that question. So there's a question from Anthony. Why do you think the dollar per square foot for Elysium was materially lower than comparable properties, particularly the next door lot, which was purchased for actually 3.48 million and land at a higher square foot? That's a great question. The truth is, Ian and I met this owner, his name is Ed, twice before we signed this deal. Do you know why the price kind of sounds too good to be true? Do you want to give your view on why we got this price? I personally don't know, but maybe you can give some information since you met him too.
Yeah, so the owner, Ed, he's a really nice man. He's owned the property for a really long time and he acquired it for super cheap. And we're not sure, but we're guessing that maybe one of the reasons why he was willing to sell to us, he actually, he put the property on and off the market a few times, and was kind of on the edge about selling. But because we met with him and we actually were able to connect with him, for example, his daughter went to UChicago and I'm going to UChicago, and he liked us, and he also liked the fact that I was like a young girl trying to get into real estate. And so, yeah, we're not really sure. It was a really good price, but we were able to connect with the owner well. He has also just owned the property for a really long time. He is friends with all the tenants, which is why the rents are so under market. And he doesn't really want to kick any of them out. Yeah, so that might have something to do with it.
Yeah, another reason, and we don't know, we didn't try to ask, is in sort of looking at a lot of properties, especially in some of the smaller multis. If you go to St. Pete and you look at something that's 60, they're typically represented by CBRE, Marcus Millichap, Cushman, very professionally. And these professional multifamily brokers obviously know the market and will squeeze it. But we have encountered a few smaller ones, 5s and 10s and 20s, where they're represented like by their best friend, or by their cousin, or by their brother, and these typically are retail brokers. They deal with single families, and so we do see some opportunities in some of the smaller ones where there is a disconnect in terms of what the retail guys think. I'll give you an example, a deal that I lost a couple of years ago in the historic Northeast, one of my other favorite submarkets, was listed by a retail broker. And they listed it in CoStar saying these 35 units were a knockdown land development play. And it was there for like 380 days and nobody looked at it because it basically said, this is a knockdown play. When we looked at it, we said, wow, this is not so bad. Why don't we just refurbish it and make it a cash flow multifamily play? So we did make an offer, but then somebody came and stole it, I think from us. So we do see some disconnects if we look hard enough, but we don't really know why. We're just happy we got it. Hopefully that non-answer answers something. We have a bunch of questions from my mentor, Clifton. Let's see. Clifton asks, is anyone permanently based in Tampa and who is primarily responsible for managing the GC and renovations and the PM, I think. So who's that?
Hi, so I am permanently here now. I just moved to Tampa last month because of Satoshi. With Sun's vision, we truly do believe that having a partner local is very important, especially with the model that we are doing, the flexible leasing, the rehab, and also the stabilization period does involve more hands-on versus traditional long-term rental properties. So I am here and we have a wonderful GC team and we have a designer team. We also have the PM. So we all work together during rehab and post-rehab as well.
Hey, Cindy, don't go yet. There's another question that you should take over. Sharon asked, she heard 2 to 4 months for Reno. Is that correct? What is your time frame and worst case? And then maybe I think you can address the parking spaces for Y15.
Okay, so 2 to 4 months, we are being very realistic about it. With Satoshi Rehab, we were very aggressive from the beginning. We had a timeline of 4 weeks. And then actually we are very proud of what we accomplished within 4 weeks, although it was not 100% completed in 4 weeks time, but we were about 90% completed. So with Satoshi, we are at the tail end of the rehab. As a matter of fact, next week we can go live. So that's about 6, maybe 7 weeks at most with Anderson, right? So, and with Anderson, that's 17 units. I mean, we started out with 19 units. We decided to convert, take out 2 units to make the lobby area. So with Elysium, 12 units only, we are pretty confident that we could accomplish the rehab within 2 months. The GC team that we work with, they are very efficient. They are very, they have a lot of crew member. And having done Satoshi Rehab, I think we work out all the kinks so that with Elysium, we strongly feel and very confident that can even go more smooth with the whole rehab project.
Yeah, just a bit more background. Thank you, Cindy. The GC that we are currently using for Satoshi is also the same team that did my 76 unit property in Clearwater that, again, we're selling next week. So I can't say they're perfect, Cindy, but as those of you know that in the GC world, we have met drunkards, we have met folks that just don't show up. These guys are not perfect at all, but they are probably as good as we're going to find for this type of asset. So we're fairly comfortable with the 2 to 4 month time frame. I think the second question from Sharon was the parking spaces here. Why did you use 15 as your base assumption for base case?
Yeah, so Sharon is commenting that 15 parking spaces seem very few. So after we did a lot of research on comping for parking, we settled on 15 parking spaces at around $100 per month. And that's definitely conservative because there's so much space in the lot. So during the 2 to 4 months when we have the renovations and also just before we add additional units, we're going to rent out as many as we can. So if that's more than 15, then we're going to do more than 15. But just for the base case and because we want it to be conservative, we put 15 as our assumption.
Sorry, I just want to add one more thing to the previous question. So since we are doing the rented flexible furnished leasing model, so we have the PN company that we use, they are specialized in short-term rental space. And I have experience in the short-term rental space and have connections in that space as well. So as part of the setup, the rehab is one piece, but then we need to also furnish the property. So we have resources to source these materials at wholesale price. And we are, so yeah, so the whole process, the whole project, it's pretty smooth.
Okay.
You're muted, Dad.
Hi, I was saying we said 8 to 9. We do have a bunch of questions. I think we can target to close this out at 9:15 and in about 11 minutes. That's okay. So next question is from my friend Murray. Is there a risk of refi at all? Great question, Murray. Frankly, we would love to have more partners in this deal that are very debt savvy. For the past 6 deals, we've had problems with every single loan. We've never had a smooth loan. We had one bank that basically the day before closing changed the terms on us on the signed term sheet. We've had this bank, we had a recap that we closed a $23 million deal a few months ago in South Tampa, and the rate cap advisor insurance, the rate cap provider, which provides the interest rate insurance, triple the cost based on the term sheet. So we've had horrible experiences with lenders, Murray. And this one, when Ia presented it, she said, we have 3 options. Even though we have a signed term sheet, I don't trust it until we have it. There's a lot of steps to it. So we do have another traditional bank, which is a floating rate backup. And then we have a bridge loan as a backup, which case would make the loan higher. Now, to answer your question on refi, refi depends on a lot of things in the market, but mainly the lenders are looking for stabilized. If we can get 75% now, we're not really stabilized yet. Certainly, if let's say in 3 months, we are now at the BFL model and we're hitting those numbers, depending on the lender, they're looking for sometimes a sort of a T3, 3 months of historicals. Sometimes they need T6, sometimes they need T12. So a lot of it is really relationships with the lenders. We would imagine somewhere between 4 to 6 months of very good numbers to show that we're stabilized, would then get us to a 75, 80% refinancing possibility and much better terms. But we're not, yeah, so that is one of the dangers of this deal, as with the last 6 deals. Let's see. Okay, so I have 2 from Clifton. Let's see. He's asking tough questions. Norbert asks, you call this a forever investment. What would trigger you to exit? Or is it focused on NOI distributions for cash and cash returns? Yeah, that's a great question. So in my past 6 deals, frankly, the 2 exits that I mentioned, I did have partners. They're great partners. But the Clearwater deal and the Dunedin deal, I think Norbert, you're investor in that one, were actually assets that I was hoping to keep long term. But since I had partners in those projects, and we voted to sell it, we sold it. We're selling them. For this Elysium and for Satoshi, we handpicked really just a few co-GPs and a few LPs that not only understand but support a refinancing so that we can return capital, but then be in a position to keep the asset forever, as we said. So the idea is post refi, as I'm currently in New Jersey with my brothers, I've done some refis in smaller multis that we just keep forever once we return the capital. And so we hope to do that with Elysium as well. Forever doesn't necessarily mean forever. If somebody comes and offer 50 million, I think we might say we will sell it. But forever means that post refi, getting the capital out, as long as the cash flow sustained in new debt, and we have chance to sort of add value with ADUs or potentially take it to 20 stories, we would keep it as long as it makes sense. But we're not under the sort of the typical syndication strategy of promising the investors and partners that we would sell this in 3 to 5 years and then have to exit. We believe if we can find assets like this and refi and keep them and they cash flow, obviously eating into the debt, which should be cheaper than inflation, that this is really a long-term way to create a generational wealth. Let's see, just hi Suzette. Okay. Hope that answers that. And I think we have a few more from Clifton. Let's see, once A2 debt paid off and equity refinance, what is the ownership? Yeah, so so A2 debt 12% will get paid, as you know, after the primary debt. Anything left over, the A1 would get a 7% preferred, and then post 7% preferred, then it would be a catch up for the common, right? In the case of a refi, assuming that it's we can refi out all the money, then the equity. Let's say if the total capital stack is 3 million and we refi 3 million, then we would keep the same pro rata equity ownership between the common and the A1. I'm not sure if that makes any sense in verbally this late in the night, but we can add this into a scenario in the Dropbox tomorrow. Clifton also asked, asset management fees 2.5 because of the small size. Is a long-term vision of a larger project materials. Would this be? Yeah, this fee. If we can get approval to get this to 50 units or 100 units, then the 2.5% asset management would be too small. It would be too large. Are any of the lenders requiring personal guarantees? For normal carve out, yes, the answer is so this goes back to the loan. The smaller deals that we've done do require personal guarantees. And in this case, I, San, am the guarantor of this loan. So I'm on the hook if we do something bad.
Uncle Mike also asked a question about if you can only invest only in A1 shares. And the answer is unfortunately no. You have to invest 1-to-1 in A1 and A2. So for example, the minimum is 25K. If you were to invest that amount, it would be 12.5 in A1 and 12.5 in A2. I think that's all the questions. And also Marichelle asked to see the funding timeline. So if at the end, once we're done, I can screen share and show that again.
Yeah. So, okay, let's wrap this out. It's 9:12. I'll just say thank you, everyone. Again, it's great to get some, again, I see a lot of partners and mentors and friends here, so it's great for everyone. We would love to hear from you in the business model. Again, we'll make this share and get suggestions. We honestly don't necessarily need the money for this project, but we want to hopefully bring on folks that are interested not only in Tampa or for long-term cooperation, but especially interested and could potentially advise us or help us in different ways in better executing and scaling up this business model. That would be very interesting for us. As an example, I met the broker that represents a lady in Tampa. She's in her 70s. She owns 70 apartment buildings of similar size to Satoshi and Elysium, all in downtown St. Pete and in the historic Old Northeast, which is right next to St. Pete. And the smaller projects are a lot tougher to get lending and financing, especially pre-stabilization. And so we're looking for folks that are interested to potentially work with us and be a bit more creative in financing, a bit more aggressive sometimes if the deals come to the market, to hopefully acquire a lot more Satoshis and Lithiums in the same area, so we can scale this up dramatically. So other than that, Don, okay, thank you. Again, very excited. Thank you for coming. The recording, the deck, everything will be there, and reach out to us. Love to hear from you. Sophia, Cindy, Irene, Iya, you ladies have anything to add? If not, we can say good night.
Thank you for coming.
Yes, thank you so much.
Thank you, guys.
Thank you all for coming to our webinar tonight, and hopefully see you with the journey with Iya's FF21.
FF21, yeah, we got to close this and a few more so Daddy can retire. Good night. Good night. Bye.
Good night.